Well, good morning, Jagendra Rana here. The topic for our discussion today is public offerings of securities insurance. Public offerings of securities insurance. An initial public offer, that is called IPO, is the first sale of shares to the public by a privately owned company. The company is going public, raises funds through IPO for working capital, debt repayment, acquisitions, and a host of other uses. An investor can apply for IPO stocks in India by filing an online IPO application offered by the stockholders and banks. Though India is now more attractive for growth seeking foreign capital given the recent decline in China's stature. So, as an investment destination, yet volatile, market conditions have led to a significant slowdown in the IPO market during the first quarter of the year. So, the other factors contributing to the slowdown are geopolitical tensions, price corrections in overvalued stocks, growing concerns about a rise in commodity and energy prices, the impact of inflation and potential interest rates hike, as well as the COVID-19 pandemic risk. So once the current scenario settles, a lot of IPO may start coming to the market in the next 3 to 6 months, especially those who have chosen to park their public offerings until the market stabilizes. Companies planning to raise funds through IPOs are a mix of traditional companies with long track records, as well as newer age companies across various sectors such as consumers, pharmaceuticals, technology, logistics, and financial services. The IPOs are a marketing event for the issuer. Given the hype pre-IPO with most companies, there is an increased scrutiny and accountability post-raising of capital. Paytm, Zomato, Kalyan Jewelers in India, Reliance Power, ABSL, AMCs are a few of the popular IPOs which failed. The stock price of the company did not meet the valuation at which the stock was listed. More than 40% of the IPOs this year have failed in the first half of the year itself. More so, the startups is the management up to such challenges. So, POSI is a specialist product which is tailored to indemnify insured against claims arising from the error, omission, misrepresentation, and non-disclosure in the documents issued to potential investors and the cost involved in defending such allegations. So many dreams of taking their company public. Talent and drive transform the dream into reality. But the reality is fraught with risk. Suddenly, company performance and decisions are subject to external scrutiny. Investors who help to achieve the dream can turn it into a testing reality. Directors of newly floated companies run the ever-increasing risk of being sued or investigated if investors' expectations are not met. So the road to a public offering is hazardous. Investors and their advisors must be presented with detailed information with which to judge the financial position and prospects of the company being floated. The directors and others face a difficult task in ensuring that all relevant information and material facts regarding the company are presented accurately. So it is ever possible to be confident of total accuracy. Investors experiencing a loss and the value of their shares will seize upon the mistake and may claim that they relied upon it when investing in the company. Means who can sue? Investors may bring an action against management for an alleged misrepresentation, error, or omission in the prospectus on which they had relied to make their investment. Regulatory bodies have authority to initiate proceedings against the parties to an offering in the event of allegations of wrongdoing or a breach of the listing rules. Then what are the coverages? Protection against potential statutory exposures, other exposures from the transactions, potential against the liabilities arising from the issues of the red hiring prospectus, the roadshow presentation and any press release, etc. Exposures arising from many overseas jurisdictions. Then what has to pay? Defense costs, regulatory investigation costs, administrative expenses, reputation and response costs, proactive forensic service cost, repair of individual and company's reputation, notification, monitoring electronic data, damages and settlements, punitive and exemplary damages, interest on judgments and awards. So PSI should be a prerequisite for every organization planning to raise capital from the public, be it a public offering of securities, debt, or equity rights issue on private placements. So difference between D&O and POSI. A POSI policy operates to ring fence the transaction exposure, leaving the D&O policy to respond to business as usual, risk faced by the directors. When undertaking a public offering, many organizations purchase a POSI policy alongside their existing D&O policy. So the scope of D&O contracts exclude public offerings even if the cover is extended by paying an additional premium. There are many benefits of having a standalone POSI cover, like a broader set of beneficiaries organization, D&O controlling selling shareholders and offering underwriters. POSI are multi-year policies and can be customized to offer protection for multiple years with a one-off premium levied for the full period of the policy. Also, policy coverage cannot be cancelled by insurers without the insured's consent. So the premium for IPO policy can be capitalized as a part of the process of fundraising. It can be claimed as an IPO expense under the Income Tax Act. So automatic cover for follow-on offering, including roadside or including road shows within 12 months of the initial offering and up to 25% of the initial amount raised can be opted for. So what could be the reasons for claim? Receipt of undisclosed commissions, rendering the prospectus false and misleading, illegal tie-in agreements between underwriters and some investors in return for receiving a favorable allocation of shares in IPO, fraudulent use of money raised, overcompensated or overmatched management, failure to disclose material information, forward-looking statements, profile and accuracy of resumes of directors and management, false promises, and quality of investments. So legal disputes are not disclosed. A company withdraws its public rights offers shortly before it is due to close after regulators receive a complaint that the company had failed to disclose that it was in substantial legal disputes over terminated contracts. As the directors and other individuals involved in preparing the prospectus face investigation, legal action and possible civil and criminal liabilities for any false and misleading statements made in its prospectus. So a construction company issues a prospectus for an IPO which includes financial prospectus for the forthcoming year, but the company falls well short of its forecast, issuing several profits warnings and the share prices fall dramatically. Investors who purchase shares based on the prospectus pursue legal action to recover their losses, citing amongst other things the company and its directors' misleading and deceptive conduct. So typical claim scenarios are there. Failure to adequately inform. A manufacturing company initiates IPO but its prospectus fails to adequately report the poor quality of their assets. Shareholders who purchases right based on its information are disappointed. So they file the suits. So correct information should be there. Thank you. Thank you.